Welcome to another Options Trading Minute. I'm your host, David, and the information provided here comes from Patrick Ceresna, Chief Derivative Market Strategist for OptionSource.net. In this Options Trading Advanced series, we'll discuss in deeper detail the options pricing. When looking at an option chain, there are many different expiration months and strike prices available. So how is the price of each option contract determined? Quite simply, options are priced on probabilities. These probabilities are calculated using different pricing methods, the most well-known being the Black-Scholes pricing model. So what makes up the price? There are several variables that influence the price of an option. Those variables are the price of the underlying, the strike price, the time until expiration, the volatility of the underlying, any dividends outstanding, and the current risk-free rate of interest. Let's take a closer look at the first pricing variable, the price of the underlying. This is the simplest variable to understand, as most investors can easily visualize the relationship. As the price of the stock increases or decreases, the options price will change correspondingly. The second pricing variable to consider is the option strike price. The strike price represents the price that the option is exercisable. The closer the stock price is to the strike price, the more expensive the option. The time value component of the option is the greatest when the stock price and the strike price are equal. The third pricing variable is the amount of time until expiration. This is simple to understand. The more time that an option has, the higher the option price will be. The closer an option gets to the expiration date, the faster the time value decreases. The time value component of the option premium will be worth 0 on expiration. To emphasize, only the time value component of an option decays, and any intrinsic value remains intact, influenced only by a move in the underlying security. The fourth pricing variable, the implied volatility of the underlying. This is an important component of the option price because it adjusts for the anticipated price movement over the life of the option. Options on stocks that have a higher probability of making a large move are priced more expensive than options on slower moving, less volatile stocks. The fifth pricing variable are dividends. All known dividends are priced into the option's value to ensure accurate pricing. This equalizes the benefit of being long on the underlying versus creating synthetic long positions using options only. The final variable in option pricing are the interest rates. The risk-free rate of interest is priced into the option. This is also priced into the option to equalize the benefit of being long on the underlying versus creating synthetic long positions using options only. All of these variables have been given specific names based on the Greek alphabet and are collectively known as the option Greeks. These Greeks measure the sensitivity of the option price to a change in one of these variables. We will cover the Greeks in another video. Although there are several variables that influence the price of an option, the beginning trader or investor needs to understand a few basic principles. First, we'll review the key correlations of call options to the price of the underlying. This again is the simplest variable to understand. When a stock price increases, then the call option will increase in price. Under those same principles, if the stock price will drop in value, then the price of the call option will also decrease in price. Next, when reviewing the effects of time decay on the call option price, the simple relationship must be understood. As more time passes, the time value component of the option price decays. When we look at the effects of the implied volatility on the call option price, the simple relationship becomes evident. As the implied volatility increases, the call option also increases. As the implied volatility decreases, the call option price also decreases. Now let's look at the put options. Again, let's first review the key correlations of put options to the price of the underlying. There is an inverse relationship of the price of the underlying to the put option. When a stock price increases, then the put option will decrease in price. Under those same principles, if the stock price was to drop in value, then the price of the put option would increase in price. Next, when reviewing the effects of time decay on the put option price, the relationship is identical to the call option. As more time passes, the time value component of the option price decays. Similarly, when we look at the effects of implied volatility on the put option price, the same simple relationship becomes evident. As the implied volatility increases, the put option price also increases. As the implied volatility decreases, then the put option price also decreases. As mentioned, all of these variables have been assigned specific names. This concept is discussed further in the Option Greeks video. See you there. God bless.